The Canadian dollar is plunging today after Bank of Canada Governor Poloz came out with more dovish talk. The Loonie had been rallying since May as the Bank of Canada had turned hawkish, and in fact, in the last few months, they've actually raised interest rates twice. It now looks, however, like the Bank of Canada is going to shift back into neutral, and they're probably done raising rates for 2017. In a speech today, following on from comments from Deputy Governor Lane last week, this week Bank of Canada Governor Poloz came out and basically said that Canadian interest rates are not on a preset course. The Bank of Canada is not going at rate increases mechanically, and that they plan to be cautious and conservative. This echoed comments from Lane last week, basically saying that the bank wanted to assess the impact on the economy from the higher Loonie, from the 2 rate hikes they'd already done, and from the ongoing trade discussions and disputes. There's more NAFTA talks on this week, and of course we saw last night the big blow up between Bombardier and Boeing with the U.S. slapping a 220% tariff on C-Series. So there are a number of uncertainties out there that can impact the Canadian economy, and the Bank of Canada and Governor Poloz have basically said that the 2 rate cuts of 2015 were no longer needed. They've removed those rate cuts and now back to where they were and at the beginning of 2015, and now it looks like the Bank of Canada is going to wait and see what happens. It doesn't look like there's any more rate hikes to come in 2017, but they could pick up again in 2018, particularly if inflation continues to ramp up. So what does this mean for the Loonie? First of all, I'll show the 5-minute chart in CAD-USD. You can see the big plunge when the governor started talking. The Loonie had actually been doing okay through most of the morning with the rising oil price, and then really turned south sharply on his comments, and it's remained low following an initial adjustment. If we shift over here and look at CAD-US dollar, what does this mean? It means we're still trending back downward. Back in the early September, it peaked just short of 83 cents. There was a negative RSI divergence, and we've seen this start to trend downwards. It looks like we're headed for a second bearish engulfing day in a row here as we get knocked under 81 cents. Key support remains 80.25, and of course the big 80-cent level. If that fails, next support down closer to 79. Shifting over now to the more actively traded dollar CAD, what does this mean? Well, dollar CAD has been bottoming out since the beginning of September. Instead of a negative RSI divergence, it's had a positive one. Not only that, the RSI has continued to trend upward, and today the RSI is broken out over 50. This is a signal that momentum's turning upward, and we're seeing it here. We've got a big ascending triangle base forming between 120.50 and 124 even, and it's just starting to break out here. If we get a more significant breakout, first resistance about 124.70, this 23% retracement and the 50-day average, then the 125 round number, and then up closer to 126.25 for dollar CAD. But this one also looks like it's bottoming out and starting to turn back upward. Another actively traded Canadian dollar pair is the Loonie against the yen. Now, in this particular case, not only is the Loonie weakening, but the yen has already been weakening as well, with capital coming out of defensive places. So far, we've seen the CAD had the big rally against the yen. It hasn't rolled over yet. It's just kind of leveling off here in this 90 to 91.60 area. However, the RSI has broken an uptrend, and that suggests that in the minimum, momentum has shifted from upward to neutral, with the potential for weakness. So we'll be monitoring which way the Loonie against the yen breaks out against this range to signal what could happen next in terms of trend.